Welcome back. This is our special coverage on the Reliance Industries numbers, and we're getting in some of the consolidated numbers. The net profits have gone up 15.6% on a quarter-on-quarter basis at 15,792 crores. Now, this is slightly better than what the street was estimating. Our poll was 15,671 crores. So the profit numbers have beaten street estimates, so that's a positive. On the top line, the revenues have come in at 2.17 lakh crores. That is a fall compared to what we've seen last quarter. The expectation was 2.31 lakh crores, but it's come in at 2.17 lakhs. So the revenues are slightly below street estimates, but the profits are better than what the street was estimating. We did get the Jio numbers a while back, and it was a stable set. I understand from Sonal that the O2C business is also quite decent. Sonal, what are the numbers looking like?
Well, yes, it's a strong set, much better than what was expected for the oil to chemicals business. If we look at the top line, yes, there has been a decline. This is primarily because of the petchem segment. The petchem segment overall has seen a decline because of lower demand, lower cracks as well, because there has been supply additions as far as the Chinese markets are concerned. But if we strip that off, because we are looking at the margins as well, so EBIT this time around has grown 16% on a quarter-on-quarter basis, EBITDA that is, for the oil to chemicals business, and that is much better than what the street was working with. There was an expectation that EBITDA for oil to chemicals business will grow by 12%, but this time around it's a 16% increase, and margins have increased by 300 basis points here. So that's a substantial improvement that we are seeing, and it is largely led by the refining segment because cracks were higher, both on the naphtha side, middle distillate cracks, all of them were higher this time around, and that is something that has led to this. Even oil and gas business, Sonia, even that one has done really well. A revenue growth of 16%, EBITDA growth of 22%, margins higher by 500 basis points. So both oil to chemicals and oil and gas, strong set of numbers.
Okay, in fact, on a consolidated basis as well, I was going through the EBITDA performance. It's a very good show, actually. The EBITDA margins have improved to 16.2% versus 13.6% last quarter. The expectation was 14.4%. So the margins are much better than what the street was estimating. Even the core EBITDA number has come in at 35,247 crores. Which is a good growth compared to what we've seen last quarter. Last quarter, it was 31,224. So that's a 13% growth that we've seen on the EBITDA on a sequential basis. So these are a good set of numbers. As we were telling you, very strong growth in the oil to chemical business. The Jio business has been quite steady state. It's a sequential improvement in the oil to chemical business as well, and the profits are much better than expected. So it's ticked most boxes in terms of the earnings. Just to summarize the numbers until we get our guests in. Revenues are slightly subpar compared to what we saw last quarter, but on the operational performance, no complaints at all. EBITDA growth of 13%, margins have improved substantially, and the profits are better than expected with a growth of about 15.6%. All right, we have Prakash Diwan who's joining us here in the studio, and we also have Abhijit Bor from Sharekhan who will be joining in a bit. Prakash, your thoughts on the earnings?
Pretty impressive. I don't think the miss in revenue is such a big concern given the fact that there was softness in crude through the quarter in value terms. But the fact that margin accretion is visible in all the verticals is just impressive. I mean, and to kind of continue to grow and improve margins is always a challenge. But as I was anticipating, Jio has contributed, so has possibly the retail as well. And we'll probably see once the numbers come in terms of where the strength comes from, but definitely impressive.
Give you the retail numbers, they are looking quite good. So it's 67,634 crores on the top line for retail. This compares to 64,936 crores. So that's a growth of about 4% on the top line for retail. But in any case, we were expecting retail, growth to slow down, considering that the middle income consumption has slowed down a bit. Has it been a bit subpar compared to your expectations, or do you think given the challenges it's fine?
Yeah, absolutely. So what they're doing is they're in the throes of consolidating that entire portfolio. So there's going to be effort or investments put into behind resources on the higher end and as well as the mass consumption products. So it's going to be a balance, and as the product mix starts deepening rather than broadening, I think you'll probably see a little bit of stability coming through in that as well. So pretty impressive. No complaints here.
Okay, we also have Abhijit Bora from Sharekhan joining us to discuss the earnings. Abhijit, thanks a lot for joining us. Your take on the numbers and what really stands out this time around, because we are seeing margin improvement across the board.
Yeah, definitely. We on all aspects, the earnings are above our expectation. We expected a 12% growth sequentially. The overall consolidated EBITDA is up by 13%. Both retail, digital has done slightly above our expectation, and oil to chemical business is also above expectation. So we see these are the strong numbers, especially on the retail side, where they have done 67,000 of revenues. This is above expectation of 64,000, which we estimated.
All right, Sudeep Bandyopadhyay is also with us, the Group Chairman at IndiTrade Capital. Sudeep, how did you like these numbers and how do you see the stock react on Monday? Because, you know, the stock has seen a lid on its gains, because of a lack of the tariff hike in the telecom vertical. There's also been weakness in global energy and chemical prices. So the stock is still about 15% off its 52-week high. Do you think there's anything in these numbers which could lead it back to those highs?
Well, I think Reliance is a long-term story. I'll tell you that. We had seen Avenue Supermart numbers, and it was expected that retail will be under pressure. We are aware that, the telecom tariff hike hasn't come. So, by and large, numbers are on the expected lines. They are trying to acquire brands in the retail and make it a much, much larger play than what it is today. I think it's a matter of time before a lot of corporate restructuring happens in Reliance and significant value unlocking happens. I'm not sure whether they're going to comment on the financial services listing and things like that separately on the management call. But overall, I think somebody having a long-term horizon, let's say at least a year, it's a great buy at current level post the correction. Now, the reaction on Monday morning is very difficult to predict. Will depend on a whole lot of other things, including how the U.S. market behaves today. But the fact remains that it is a long-term good buy. The results have been on expected lines. That's what I would say.
Okay, results on expected lines. Reema, anything? Okay, all right.
We're still awaiting the Jio ARPUs and the Jio subscriber growth, but the revenues, EBITDA and PAT of Reliance Jio had come out earlier at about 5 o'clock. And just to quickly run you through the numbers there, Reliance Jio has reported a 2.1% quarter-on-quarter revenue growth and about 19% on a year-on-year basis. But there is a slowdown that we've seen in the top line growth, which gives you an indication that perhaps the subscriber growth may not have been as per what we've seen in the past, or the increase in pricing has not played out compared to the prior quarters. So if the revenue growth this year is 19%, over the last 3 quarters, the revenue growth was over 20%. So there is a bit of a slowdown. Margins have expanded for the company by 120 basis points quarter on quarter. That's the EBITDA margins, and that's the benefit of the lower spectrum usage charge, and that's driving a jump in their profitability by 2.7%. All in all, it's still, a very steady performance from Reliance Jio, but we're awaiting the ARPUs and the subscriber growth numbers for the quarter.
Okay. Prakash, your take on the oil to chemicals business, because, last quarter we saw that big decline, of course, because of the challenges that we were seeing. This time around, definitely refining is the one which has contributed more. Yeah. But what is the outlook on the petchem segment? Because we are looking at China opening up. That is something that will propel demand according to you. And in that case, oil to chemicals will see contribution from both the sides.
Yeah, so, O2C is, as you rightly said, it's a twin cylinder play. But the slowdown in Europe in terms of end consumption is also kind of started to trickle down. And that's what you see in this quarter. And, most of the larger consumers or larger downstream businesses would have been very cautious in the quarter gone by, given the fact that energy prices were expected to spike. And petchem is an energy intensive business. So there are very clear indications that we had received earlier that petchem would probably be the slowest out of the lot. But I think going forward, if you see the rationalization of capacities that they've done in the last couple of years, that hasn't yet translated into the P&L. So that is something which could happen, and it could be lumpy. So, you'll probably have one of the quarters, I'm not sure which one, whether it's the last quarter of this financial year or whether it's the first one for the next. But at some point, you'll probably see that huge comeback of sorts from the petchem, what happened in first quarter last financial year. Right? So yeah, I mean, to answer your question specifically, once that happens, you'll probably see both the cylinders firing. But even without that, I don't see any disappointment on the margin side or the EBITDA level, being so off the mark of sorts?
Okay, the other two internals that we were waiting from Reliance Jio, the subscriber addition this quarter is 5.3 million subscribers. This compares with a subscriber addition of 7.7 million in the prior quarter. It's a subscriber growth of 1.2%. Secondly, the ARPU increase, it's increased for the 7th consecutive quarter, but the pace of increase has come down. So now the ARPU increase on a quarter-on-quarter basis is just close to about 0.6%. Remember, there was no tariff hike which would have boosted the ARPUs this time. The last tariff hike had taken place a year ago. So the flow-through of the tariff hike has already played out about 6 months ago. The increase that we're seeing in ARPU is purely on account of premiumization, some of the subscribers upgrading their plans. But again, the pace of ARPU increase has slowed down to 0.6% on a quarter-on-quarter basis, but it's still a 7th consecutive quarter of an ARPU increase. And even the subscriber growth numbers at 5.3 million is steady, but it's lower compared to what we've seen in the past. One of the reasons attributed for the slower increase in subscriber base would have been the muted smartphone shipments, in the last couple of months. You want to comment on this?
Yeah, so Rima, I think, you need to go back to what they did before they started gearing up for the 5G onslaught and especially the investments that started coming into that upgrades. There was a very conscious effort at SIM rationalization, and that is the time where the focus moved from number of subscribers to the quality of subscribers, and that is going to be taking some time because you're in the throes of losing some or culling some subscriptions and substituting them with quality names. And the MNP pace also has not been as aggressive in this quarter. We know very clearly from the channel sales that the effort that has gone into MNP has not been so great. So I think all in all, it's just the fact that the ARPU is also at that inflection point where it will start doing as the 5G rollout happens and value-added services start getting availed of. But I don't see any reason why there would be any disappointments, even if the pricing, the price hike has been probably a bit deferred than what the street would have liked to see.
So in terms of a stock price, Prakash, what are we looking at? What's the expectation on Monday? Because, I mean, to be honest, the stock has underperformed. Yes. It's disappointed. It's down quite a bit from its highs. Yeah. Anything in these numbers that can take it back there? So,
Reliance characteristically doesn't move immediately after its numbers, But the good part of this time is, Sonia, it's not moved before the numbers as well. In any build-up of anticipation that something is going to be like a blockbuster segment. And I think it's a better thing to have all segments doing well rather than just one or two segments doing exceedingly well and kind of not being able to sustain that. So from a stock perspective, you see, it's all the outflows that always hurts Reliance because it's one of the heaviest weights on the Nifty. And whenever you see money come back is when it starts gaining much more. So I would believe that time is still some time away. But as we go past the budget and the market starts getting its feet in terms of a more decisive move, that's where you'll probably see money come back to Reliance. To me, it's always been a great value. As Sudeep said, for the long-term investor, these are things. I mean, look at retail. If you're talking about 67,000 crores revenue in a quarter from a company, that's entirely almost like 70%, 75% of the industry. So, you buy Reliance, you buy India. That's the whole idea. But from a valuation perspective, I think it's great comfort at this point, Sonia, to answer your question specifically. Monday might not be a time to react, but it will continue to see accumulation till the 2700 zones.
Okay. So just a point on the auto chemicals business and the oil and gas business as well. The company has given some outlook in terms of what they're expecting in refining segment. They say that middle distillate cracks, they remain firm. However, the petrochemical feedstock volatility is something that they could see to continue because of uncertain geopolitical situations. Polyester demand is expected to improve because of shift in China's zero COVID policy. We are seeing better wedding season as well. And if we talk about the oil and gas business, they are talking about the fact that they think gas prices will remain firm in the near future and incremental production and higher prices will support EBITDA growth. Already the oil and gas business is doing so well and they are expecting growth to continue as well. So that definitely is a positive commentary coming in both the businesses actually.
Okay, in fact, Devin Choksi is also with us, so let's get a quick comment from him. Devin, your thoughts? These numbers overall, I mean, it's a strong growth for the oil to chemical business. Overall earnings are above estimates. Your initial take and what your expectation is of the stock?
Yeah, so I think initially take would be the comparative business between the consumer business of Jio and retail and the hydrocarbon businesses. If you look at, I think the EBITDA of combined business of digital and retail is somewhere around 16,900 crores. And the EBIT of hydrocarbon business is somewhere around 15,000 odd crores. So even if you, I think, try and see at the EBITDA level, I would think that most of both these businesses have probably come at the parity level. Now, this is extremely important because I think the commodity cycles, they do play some role in the performance at some point of time. But here the consumer behavior probably, I think, is giving a good amount of thrust to Reliance, Jio as well as retail business. In my viewpoint, I think these two areas are required to be looked at very clearly. Today they are at equal level now, and probably I think the way in which the growth is being seen on a quarter-over-quarter basis for the Jio business as well as for the retail business eventually, I think the amount or the numbers from consumer-facing businesses would be relatively on higher. Reliance Jio platform, I think, is now suggesting that it will be on a 60,000 crore EBITDA run rate as far as I think the next 4 quarters are concerned. And that, I think, sounds extremely convincing as far as the growth coming in from this business is concerned.
All right, Devin as well as Prakash and all our other guests, thanks a lot for joining us this Friday evening and speaking to CNBC-TV18. So just to wrap up how Reliance numbers have been, the earnings have been above what the street was estimating. That's a comment coming in from Mukesh Ambani, the Chairman and Managing Director of Reliance, talking about the quarter gone by, the challenging environment and how each segment has performed this time around. It's been a strong growth for the oil to chemical business, steady earnings for Reliance Jio. The average revenue per user has improved this time to about 178.2 rupees. Total subscribers as well have gone up. And in Reliance Retail, there is growth, but growth has slowed down just a tad bit. Thanks to our viewers for joining in, and thanks to all our guests as well. We'll slip into a short break and be back.